Hi, and good morning to everyone who's joined us today for this session of Mind of the Manager. I'm Linda Eads, and I'm joined today by Brian Arcese, who's joining me live from our Singapore offices. Of course, I'm here live in Cape Town. And we also have Ishrath Hassan, who will also be joining us for a section of the program. We did pre-record Ishrath's session yesterday because he's actually currently on a flight to Europe. So Brian and I will be actually doing the Q&A section after Ishrath's section has completed. So please do actually put some of your questions through. You'll see the Q&A box. We'll be taking a look at some of those questions that come through. And thank you to those of you who have submitted some questions in advance. And if we don't get to the questions you've submitted today, we always commit to getting back to you personally after the session. So today we're, of course, speaking about global portfolios. And I think thankfully so, given everything that's happening locally, of course. We'll be covering our global outlook and positioning. Brian is going to actually take you through some of our macroeconomic thinking, where we're sitting in terms of the global landscape, and how that sort of all fits together from a top-down perspective in terms of the positioning in our funds. And then Ishrath is actually going to highlight one of the investment ideas that is actually making its way into our global portfolios. And this is obviously one of many different investment ideas, but it's to give you a very clear sense of how our top-down macroeconomic driven process, which looks often at themes, is forward-looking, looks at shifts and transitions, which create opportunities, of course, and then puts that together with finding the best bottom-up opportunities to populate our global funds in this case. So many of you will be familiar with our global funds, in particular, the Foord International Fund, which has been now going for more than 25 years. It celebrated its 25th anniversary not too long ago, as well as the Foord Global Equity Fund, which is, of course, our very much global equity-centric fund. But we also have an Asia ex-Japan fund. All three of these are denominated in US dollars, but we do have feeder funds available for the Foord International Fund and the Global Equity Fund available here locally. So if you're interested in any of these funds, please do get in touch with your Foord contacts. So with that, I'm going to be turning to Brian, who's going to be looking at the global outlook and the positioning from a top-down perspective. Over to you, Brian.
Thank you, Linda. And as Linda mentioned, I'm Brian Arcese, one of the multi-counselor portfolio managers on the Foord Global Equity Fund and the Foord International Multi-Asset Fund, based in Foord's global office here in Singapore. For much of 2022, and certainly the first half of 2023, notwithstanding what's currently priced into markets, investors have seemingly been waiting for, and in many cases positioned for, what is increasingly becoming what could be the most anticipated recession in recent history. But where is it? I mean, why hasn't it arrived? Is it still coming? Well, I will attempt to address many of these questions over the next 15 minutes. At Foord, we'd suggest that, well, burning from an academic or intellectual perspective, perhaps they aren't the most important questions to ask when working to appropriately allocate portfolios for the coming years, nor are the answers likely to be the largest determinant of asset class returns over our forecast horizon. Over Foord's 40-year history, and as Linda mentioned, our 27-year history managing our global multi-asset international fund, we've always stressed the importance of constructing portfolios that are diversified across economic risk, that can grow investors' capital in real terms through an investment cycle, and are not reliant on a single economic outcome, but are rather what we term all-weather portfolios. Today, I aim to achieve two primary goals. First, to walk through our economic base case assumptions. What, if anything, has changed since we last spoke earlier this year? What risks do we see on the horizon that could impact our forecasts? What is the probability of each of those risks coming to fruition? And ultimately, what would be the magnitude of the impact on asset classes, markets, and our portfolios? Second, and more importantly, is to convey how we use these base case forecasts in constructing our own portfolios. I'll speak through our portfolio construction philosophy a bit and how we arrive at our all-weather portfolios that aim to outperform through time. As we've highlighted on several occasions over the past 3 years, including most recently when I traveled through South Africa in January, the three most important determinants of economic growth and therefore market returns have been recently and will continue to be interest rates, inflation, and earnings, in particular, cash earnings. Let's look briefly at where each of these stands today, and more importantly, our expectation for each of them over the coming 12 plus months. Now, though it remains possible, if not probable, that headline inflation will trend down towards the 3 to 4% level between now and year end, as shown here, Small Business Survey typically leads headline CPI by a handful of months and is already intimating a continued moderation in inflation between now and year end. It is equally possible that services inflation, including wage inflation, may remain stubbornly high. While having also come off its peak, US services inflation still neared 7% in the most recent period, and wages are expected to grow close to 5% in the current quarter. Though clearly also on a decelerating trend, the key question outstanding remains, will the deceleration occur quickly enough with inflation rates arriving at a level palatable enough for global central banks to have already reached or nearly reached peak interest rates for this cycle? By many accounts, the US labor market continues to remain strong. Last Thursday in the US, we saw the JOLTS data, so JOLTS stands for Job Openings and Labor Turnover Survey, released where job openings surged to 10.1 million, above expectations and representing 1.8 job openings for every person looking for work. Historically, any number above the 1.1 to 1.2 jobs per unemployed person would indicate a strong labor market and result in upward pressure on wages. The JOLTS data was followed on Friday by non-farm payrolls data that exceeded even the highest of expectations. Now, the devil is always in the details, and digging one level deeper into that report, we do see both an uptick in unemployment and a further deceleration in wage growth. Though unarguably a strong labor market, wage growth and employment prospects may be cooling. While the current strength in the labor market is evident, at least in the current data, it is not necessarily a foregone conclusion that goods inflation continues unabated in its downward trend either. And I'll highlight two of several examples that we could use of the potential for goods inflation to remain elevated, or certainly above the previous long-term trends for a relatively long period. First, well, textbooks may teach us that the least expensive way to manufacture something is at scale in a single, large, optimized manufacturing facility. Both COVID and geopolitics have taught investors in recent years that through a number of starts and stops of supply chain disruptions, this is not necessarily correct in the real world. As global corporates invest to diversify their supply chains, in many ways duplicating portions of them in different parts of the world, this most certainly will be inflationary. Secondly, and I use this example because it also allows me to highlight the forward thinking of Singapore, where we've placed our global team, is the renewed focus on national food security, in no small part driven by the Russia-Ukraine conflict, where the world has previously sourced nearly 2/3 of global wheat and grain. So Singapore, a small island nation with limited natural resources and little arable land, will produce 30% of the population's nutritional needs locally by 2030. Certainly, producing food locally is often more expensive than sourcing it from the region, which would have the lowest cost supply. So this too on the margin is certainly inflationary. To conclude, our views on inflation remain unchanged. Despite a deceleration in goods inflation and a slightly slower deceleration in the services component, our base case forecasts have inflation persisting in the 3 to 5% range for longer than is currently priced into markets. Though certainly one of the fastest tightening cycles, both in speed and in order of magnitude, at least in percentage terms, the full effect of this tightening has yet to be felt. While economists are able to look at both academic models and historic data when attempting to calculate the time lag between interest rate increases and the underlying impact on the economy, it's far more science than art. Certainly, the interest rate sensitivity of many developed market economies has decreased, with an ever larger percentage of GDP being contributed by services firms. Notwithstanding the rapidity of recent increases in rates, there are large differences in the magnitude of impact on underlying economic growth if the starting point is effectively zero, or if interest rates were to move from 5 to 10%, for example. Of course, the difference in that impact is not easy to measure. Now, as I highlighted earlier, our base case calls for inflation to decelerate, but to remain above central bank targets. Not uncoincidentally, we remain of the view that central banks will stay resolute in tackling this inflation, choosing to err on the side of interest rates remaining higher for longer if given the choice. Market deceleration and inflation coupled with moderating wage growth, an increase in the unemployment rate, and at the time earlier this year, transitory crisis of confidence in portions of the US banking sector resulted in modest tightening of credit conditions. I mean, this has given the Fed room to potentially reason to pause. Though a pause may be sensible, we disagree with current market expectations that are pricing in interest rate cuts between now and the end of the year. Though we really aren't in the business of forecasting monthly Fed moves, our base case expectation would be for a pause this month, which is more or less built into the market, though importantly, with a recognition that interest rates may need to move even higher before they've reached their peak. So barring a currently unforeseen event, whether it's within or outside of financial markets, we don't currently foretell interest rate cuts in the near to medium term. Now, for those of you that have followed Foord for any amount of time, you will likely have heard each of us speak incessantly about earnings, in particular, cash earnings. So embedded firmly in our investment philosophy is the view that ultimately what a firm can earn in cash determines its true worth. It has been our expectation, as highlighted more recently during my trip to South Africa in January, that peak US corporate margins, mid-single digit or higher inflation, depending on the components, and rising interest rates would both crimp corporate investment and weigh on earnings over time. While we've been directionally correct, and earnings growth has certainly slowed materially, particularly in real terms, and is virtually flat on a year-over-year basis, the magnitude of the earnings correction has been less than we would have expected. And as a result, the expected impact on the shares of US corporates has not come to fruition, or probably more accurately, perhaps not yet. As US manufacturing data, including PMI and ISMs, have been weak for quite some time, this is likely the most widely anticipated developed markets recession in the recent past, as I mentioned. We thought it would be helpful to look at what really has been supporting the underlying economy. Why has the recession that investors have seemingly been expecting not yet materialized? So, though not an unknown at this point, I thought I'd include this chart as a simple reminder of the progress that the US consumer has made in deleveraging post the 2008-2009 financial crisis. So if measured in loans to total assets, or when looking at consumer debt service ratios, US consumer balance sheets haven't been this robust in decades, really. But what is less appreciated than the deleveraging components of the consumer overall has been the increase in real wealth, particularly in the bottom 50% of US wage earners. Certainly in no small part aided by significant payouts over the COVID period. I mean, it's been estimated that this cohort in particular was still holding close to $350 billion in excess savings through the middle of last year. So this $350 billion in excess savings concentrated in a cohort with a far higher propensity or need to spend than upper income cohorts has provided material support to the overall economy over the past 12 months. Additionally, and interestingly, US consumers are among the least interest rate sensitive in the world. So it's estimated that the 300 basis point increase in interest rates in the US only has a 1% decrease in disposable income, all else being equal. Now, to put this in perspective, this is lower by a factor of 10 relative to those countries or economies at the higher end of this scale. And further, while adjustable rate mortgages comprised nearly 1/3 of the US mortgage market prior to the 2008 crisis, today this number is less than 2%. So over 98% of US residential mortgages are fixed rate, with 80% being fixed for more than 20 years. So though already the largest component of US GDP, the US consumer has contributed an outsized portion of growth during the first quarter of this year. And that certainly has helped contribute to the strength of the US economy. But where do we go from here? At present, risks to our base case are somewhat balanced. While the strong US consumer and their excess savings built over the course of the pandemic have been enough to propel the economy at a 7% nominal rate during the first quarter, these excess savings have been significantly depleted. On the other hand, a sluggish manufacturing sector has begun to show signs of green shoots, with global PMIs bottoming, the ISM bottoming, and US inventory destocking possibly nearing an end as well. Can the torch be passed seamlessly from consumer to corporate manufacturing-led growth? We don't really place a high probability on this outcome materializing. Any potential uptick in inflation, which could result from goods manufacturing reaccelerating, particularly an acceleration in inflation, which would require further interest rate increases, would almost certainly give the market a shudder from what are currently elevated levels, particularly in certain sectors. Alternatively, decelerating inflation, a continued resilient labor market, contributing to further consumer strength amid a manufacturing revival, could propel markets even higher, the so-called Goldilocks scenario. Investors really must be aware of and position their portfolios to perform well, or at least at a minimum offer protection in the face of what could be viewed as two opposing scenarios. So at Foord, we've always viewed ourselves primarily as risk managers rather than strictly portfolio managers. We construct portfolios to guard against a number of risks, not least of which is the risk that we may be incorrect in our forecasts, whether by outcome, magnitude, or timing. We work to forecast risks to our base case assumptions, as well as the probability of any one of these risks occurring, along with the resultant magnitude of the potential impact. We purposefully construct portfolios to not be reliant on a single binary outcome, but rather to be all-weather, performing well if we are correct in our views, while protecting capital if we are not. Investors must not only form their views, but also compare these views to what's currently priced into markets to determine if an opportunity for alpha exists. Though we've passed what was potentially a low probability risk, but certainly one with a high magnitude of impact had it come to fruition, the recent raising of the US debt ceiling, numerous other risks remain. A most certainly non-exhaustive list, and one that we're focused on, includes heightened geopolitical risk, which we're acutely aware of in Asia, but also in Singapore, having just this weekend played host to the Shangri-La Dialogue, which is an annual event where defense ministers and senior leaders from over 50 countries come together to discuss, open lines of communication, and ideally, de-escalate points of conflict. The list of risks also includes sovereign and corporate indebtedness. Now, the rapid and meaningful rise in interest rates can stress the balance sheets of even companies previously viewed to be of high credit quality. Other risks would include regulatory, which is really evident across many markets globally, and the resultant earnings risk, most importantly to firms, if any of the above coming to fruition. It's important to highlight, however, that these and other risks can breed volatility, that we fundamentally view volatility not as risk, but as much as opportunity. When looking at the opportunity set presented to us today, there's one sector and theme in particular that we not only wanted to highlight, but is also active across our portfolios globally. It offers good value, but even more importantly, attractive fundamentals that are likely to persist regardless of economic backdrop. So as seen here, the energy sector is trading at near bottom deciles, both on an absolute basis and relative to markets seen over the past 10 years. Now, the chart that I've pulled up here pertains specifically to the US market. The same would hold true when looking through a European or even a global lens. It is a compelling source of alpha in our portfolios, and I'm pleased to turn it over to my colleague Ishrat Hassan to outline the opportunity in more detail.
Hello, I'm Ishrat Hassan, one of the multi-counselor portfolio managers of the Foord Global Equity Fund and head of research of Foord's global team in Singapore. In the past, we've highlighted how Foord's perspectives on finding value and managing risk are unique and span diverse approaches and market environments. As Brian outlined, we never make 0-1 bets and always do our best to construct all-weather portfolios that work for our investors over time, regardless of the macro environment or structural changes globally. Ultimately, we are value investors, but find value in places that more traditional value investors do not. To us, value is being able to buy and own businesses at less than their true worth over time, which we assess through the analysis of long-term earnings and a deep understanding of the diverse economic sectors covered by our analysts. At times, we find value from a bottom-up valuation perspective and sometimes from a top-down macro perspective. Since we've spoken about the former approach many times in the past, today I'd like to highlight an example of the latter, where our variant perception on the top-down leads to ideas and concentration on a stock-specific level. The theme I want to discuss is very topical: the global energy transition. First, whenever we hear the word transition, our ears perk up. We love disruption and change. To us, change signals opportunity. Change invariably creates lots of noise in the near term and leads to misperceptions on the long-term reality. This creates fantastic opportunities for forward-looking investors that can look through the noise and focus on what truly matters for long-term returns: earnings. So what's going on with energy? There's a massive energy transition underway to battle global warming. This initiative began with the Paris Agreement for the world to be carbon neutral by 2050. But regulators only got serious about it in the past 3 years. Suddenly, everyone in the investment community hated oil and gas, especially following its weaponization in Russia's war in Europe. Conversely, the world and markets became enamored by anything and everything renewable, from solar to wind to hydrogen and electric. Given the sheer scale of what needs to happen to achieve net zero emissions within a 30-year time frame, we were intrigued as well and went deep into understanding who the potential winners and losers of such a transition would be. And our findings were not quite what you would expect. But before we get to that, I need to introduce you to the concept of energy density, which will help frame the discussion and our positioning. Hydrocarbons such as coal, oil, and natural gas are packed very densely with energy, and renewables like wind and solar are not dense at all, which means you require a lot of materials to compress and harness this energy to get the same output as hydrocarbons. This spectrum can be categorized as clean versus dirty, intermittent versus reliable, weather dependent or firm, electrons versus molecules, or renewables versus thermal. Dr. Scott Tinker and his team at the Switch Energy Alliance have a lot of data on all this, some of which I will go into shortly. So let's dig into what all this means. Energy demand globally is directly correlated with prosperity and rising GDP per capita. As countries become more affluent, they consume more energy. And if you look at how energy consumption has evolved, no primary energy source has decreased in consumption since 1965. Not even coal, despite the vehement opposition against it over decades. In fact, we still consume more coal and oil today than all the other energy in the world combined. As long as there's population and wealth growth, there will be greater need for energy. Many people will tell you that solar and wind are growing exponentially, and this is certainly true. But this needs to be put into context of the overall energy mix and what's required by the world over the next 5 to 7 years, which forms our investment horizon. Over the past 10 years, despite this exponential growth, solar and wind have only been able to provide the world with 10% of the growth in energy demand. This is not total demand, but just the growth in energy demand over the past 10 years. 90% of energy demand growth has still come from more dense energy sources, which to us was staggering. Such are the needs of a growing global population with rising prosperity. Let's break this down further to understand if anything can change that would compel us to invest heavily in any one medium. Let's look at energy demand by region. Demand in North America and Europe have been flat for almost 40 years. And all the demand growth is coming from Asia and the rest of the world, which makes up more than 75% of the global population, where prosperity is just getting started. In fact, Asia consumes more energy than Europe and North America combined. Within Asia, let's break down the two biggest economies of China and India. Both countries consume more coal than all other energy sources combined. The big difference with India is that they just consume a quarter of China's total energy demand, despite now having a larger population. This just means that India's per capita consumption is where China was back in 1995. If India follows the same path to industrialization as China, you can imagine how these charts evolve. The entire developed world, including the US and Europe, was built and industrialized on coal. And now the same is happening with the emerging world. Coal is simply the cheapest and most dense source of energy on the planet. And guess who's consuming everything being produced in Asia? It's the developed economies that want their goods produced cheap and also want to transition to cleaner energy. Sadly, Asian hydrocarbon use is enabled by the consumption needs of developed economies. They are importing emerging market goods while exporting carbon emissions. Now, within the broader energy mix, gas use is increasing dramatically. And this is great news because it's a very dense source of energy, but produces far lower emissions than coal and oil, which are much bigger problems for the environment. Gas will soon pass coal as the most used fuel globally and should be a big positive for the environment as a gateway fuel to renewables longer term. The other thing one needs to keep in mind when thinking through how the energy mix evolves is energy security. While North America is an energy producer and net exporter, Europe, China, and India are big importers. So more than 75% of the global population needs more energy than they produce. This has been a big driver of the move to renewables and electric vehicles, particularly in Europe and China. The world expects electric vehicles to increase by 3 times, from 17 million last year to 55 million by 2025. China alone will account for more than half of this. And how will China charge its electric vehicles? Remember their energy mix chart? A big chunk of their electricity comes from coal. There are other reports that say the world will electrify half of the global vehicle fleet by 2040. We have 1.4 billion vehicles on the road today, so this would mean 700 million electric vehicles in less than 20 years. Each car has 5,000 battery cells, so this would work out to 3.5 trillion batteries, all of which would need to be replaced every 7 years. How do we dispose of all this waste? And what about the affordability of battery materials? Remember energy density? This is exactly where we run into problems on the speed at which things like electric vehicles, green hydrogen, and renewables can ramp. Just look at what happened to lithium prices when it was supply constrained, with prices going up more than 7 times over the past 3 years. Going forward over the next decade, demand for all electrification materials will exceed supply wildly if we are to get anywhere near electrifying half the vehicle fleet globally. This is a very telling slide. It takes 8 times more metals and materials to produce an electric vehicle versus an internal combustion engine. 7 times more minerals like copper to produce solar and wind than conventional fuels. What happens to costs when there's a shortage of copper, gold or silver? All highly conductive materials that will need to participate heavily in the quote-unquote electrification of the world. And what about pollution? Internal combustion engines require drilling and produce emissions, but solar, wind and EVs require mining and landfill disposal. There are substantial environmental impacts either way. It simply takes a lot more manufactured material to harness less dense energy sources like the sun and the wind than hydrocarbons. And where will these materials come from? The top 3 countries producing oil and gas are the United States, Saudi Arabia and Russia. The countries producing the materials for solar, wind and batteries are more diverse, but this is just from a mining standpoint. If you look at the processing of these materials, China dominates all supply chains. Then consider the largest oil and gas producers globally. If you combine the 2 biggest producers from Russia, they become bigger than Saudi's Aramco. And you need to combine the next 5 international oil companies, Exxon, Shell, Chevron, BP and Total together to match Russia's production, which is staggering. So what does all this mean for geopolitics and the future energy mix? The supply side looks precariously positioned for the foreseeable future. Many things can go wrong given the actors involved, yet everything needs to go right given the extremely ambitious target to net zero by 2050. Hence, security of low cost and incrementally cleaner energy supply will be paramount for the world to progress. There will be significant environmental impacts no matter what the energy source. While the sun and wind themselves may be renewable, harnessing them is very material heavy and expensive. The world will also require lots of energy from many different sources. If you suddenly remove dense fuels like coal, oil and gas, large parts of the world will be starved of energy and be in crisis. It's no surprise then that all the countries calling for clean energy mandates are the richest countries globally. As I mentioned earlier, more than 3/4 of the global population live in some form of energy shortage. So what we believe needs to happen is actually quite different from what is being priced into many stocks and businesses in the sector today. To us, the energy transition simply means that we need to add more energy while doing our best to reduce emissions. Given everything I've outlined, there's almost no scenario under which oil and gas demand or even supply can shrink over the next decade without causing major problems for the world. In fact, both oil and gas needs to grow in order to displace coal, which is a much worse carbon emitter. The world will require all energy sources to grow, but we must always prefer cleaner sources to dirtier ones. If oil and gas production does not grow, just as we saw with lithium, you will see substantial price spikes that will be highly inflationary and detrimental to the world, but ultimately benefit oil and gas producers and service companies. If you look at oil and gas exploration spend over the past 8 years, it has more than halved since 2014, given myopic misperceptions that the world can transition away from these hydrocarbons so quickly. Supply is going to be highly constrained in the coming years for many reasons, including misplaced shareholder pressure. It's the same for scarce electrification materials like copper. Just consider what happened when Russian gas supply was disrupted last year. Even with Europe generating more than a third of their electricity from wind and solar, which is one of the cleanest energy mixes globally, their cost of electricity rose to more than 6 times the United States. How can they remain competitive from an industrial standpoint? Only the richest countries in the world can afford this kind of energy transition, especially at the pace that is needed. And while renewables will grow, the long-term economics of solar, wind, hydrogen, battery, or EV companies remains very murky to us, just like the internet and software companies back in the late 90s. Tesla is a great example of this frothy exuberance where its valuation never made sense to us. Still, we watch all of them closely for when real winners and strong economics and business models eventually emerge, just like they did with the tech sector in the mid-2000s. But this usually follows a bust cycle, which we expect this time around as well. That said, the economics of supply-constrained commodity producers or service companies that provide the picks and shovels for this gigantic infrastructure build-out are very appealing to us. So how is Foord positioned? For one, we have a very material position to the energy transition as a whole. Between old and new energy names, we have more than 15% of the global equity fund invested in businesses that will benefit from this energy transition in one form or another. Within old energy, we like businesses that have very low cost of production and extensive reserves that don't require them to spend billions of dollars on exploration, like Occidental Petroleum or Shell. These businesses will return all excess cash to shareholders and are priced today as if they won't exist in 7 to 10 years, which based on everything I've outlined will clearly not be the case. From an ESG standpoint, we like businesses that are gas-centric and investing heavily in reducing their carbon footprint, while also helping the world decarbonize by using less coal and oil. Woodside is the largest independent gas and LNG producer globally, while Total is also very gas heavy and investing in renewable power generation across Europe. On the new energy side, we like materials that will be meaningfully supply constrained for the foreseeable future, like copper and lithium. Freeport and Livent are the lowest cost copper and lithium producers globally, with fantastic management teams running them and reserves that will last decades. Gold and silver have other attributes as precious metals, but will also play a major role in electrification, given that they are the two most conductive elements on the planet, which we have exposure through the likes of Wheaton Precious Metals and Pan American Silver. We also own service companies like TGS, Quanta Services, and Baker Hughes that enable the build-out of low-cost reserves, renewable infrastructure, and LNG platforms respectively. Air Products is one of the largest and best managed traditional industrial gas producers, but investing heavily behind green hydrogen. And we have no doubt that should green hydrogen take off in the long run, Air Products will be a major beneficiary. With all these businesses, what is most important is that they present fantastic value, given that the market myopically misunderstands both their long-term earnings and valuation. Some of these businesses will likely be cyclical, but we believe that the cycles will be within a larger structural uptrend, at least over the next 5 to 7 years. Effectively, we are not making a 0-1 bet on this energy transition. Regardless of how the energy mix evolves, the portfolios and our investors are positioned to benefit. And as the data, the path, and the value evolve, so will our positioning and portfolio construction. I hope this gives you a glimpse into our perspective and the deep considerations that go into the positions we build. Thank you for tuning in, and thank you for your trust. And with that, I'll hand the screen back to Linda.
Thank you, Ishrat. And we'll turn to some questions which have come through. Excuse me. Thank you to everyone who's submitted questions in advance. As mentioned, Ishrat actually is on a flight at the moment, so he had to pre-record his segment yesterday. So Brian is in the hot seat today. We have had a lot of questions coming through on the local side, understandably, with all the headwinds that we are facing here in South Africa. Of course, Brian and Ishrat are global portfolio managers, so they're very much focused on the global opportunity set. We will be doing a webinar soon on the local funds, the multi-asset funds, as well as the local equity funds here in South Africa. But I also do commit to getting back to everyone who has submitted questions on that front. So I will get back to you personally with an answer to your questions on the South African side. But with regards to the global set, I mean, I think Ishrat set you up there, Brian, of course, talking about disruption as an opportunity, something that's been in the headlines very much with regards to the potential disruption on the world as we know it is artificial intelligence. Of course, we saw NVIDIA hitting the $1 trillion mark on market cap. So of course, this is something that is on everyone's minds. Mike has actually asked us to elaborate on any opportunities that we see and maybe some of the pitfalls surrounding kind of the transition to artificial intelligence.
Sure, it's certainly topical and a great question. I'll answer it in a couple of ways. I mean, from the fundamental standpoint, we're doing our own research on AI and how we can incorporate it not only into our research process, but also into how we manage our own business in general. And through that, that helps us develop our own view on research and investment ideas in the space. So it's still very early. Certainly the exuberance that you see in the valuation of NVIDIA, which we don't own in our portfolios, if the fundamentals required for that valuation to be sensible come to fruition, then there are other companies that we do own in the portfolio that would be in that supply chain sector, like a TSMC, for example, that would also really need to benefit. So some of the exuberance that has been sort of NVIDIA specific is probably over exuberance in our view. But we are spending a lot of time looking at AI, in particular for companies that we currently invest in, whether it's Google or Microsoft. But as Ishrat talked about on the new energy side, with kind of exuberance in new energy, but not necessarily coinciding at the moment with fundamental profit potential. I mean, in many ways, that's where we are on the AI side as well. So it's an area that we continue to watch and are invested in tangentially through kind of large cap technology players, but we don't have any investment in pure play AI companies as of yet.
And sort of going back to the macro side, we've got a few questions here which have come through from Graham, who asked, is a global recession likely in 2023? And Ian asked us a slightly different way. He asked what the impact of a recession in the US would be on the world and global markets. So let's start. Of course, we haven't completely ruled out the possibility of a recession in the US. Should there be a recession, what would you think would be the knock-on effects to other parts of the globe?
No, it's a great question. So our base case, we certainly have a slowdown. I mean, a slowing in economic growth, and we absolutely wouldn't be surprised if we had a recession. If we look historically, when inflation has been above 6% and wage inflation has been in the mid-single digits or higher, and central banks are raising interest rates to tackle this, I mean, historically, there really isn't a precedent to point to of a soft landing. It doesn't mean that you need to have a global financial crisis, but certainly in all times that we've looked at in the past, you do end up tipping into recession. And that's how you bring wage inflation back down to reasonable levels. So in our base case, you do have a slowdown. You've seen earnings kind of now come down to flat on a year-over-year basis. As interest rates rise, and as I mentioned during my portion of the presentation, I mean, the interest rate sensitivity of the economy in general is lower than it would have been 30, 40 years ago. So whether that means that you need a longer period of time before interest rates start to bite, or whether it means you need interest rates to rise to a higher level than you otherwise would have expected for them to really start to impact the economy, both of those are potential. And so in our view, well, it's difficult to kind of predict the exact timing of when a recession may happen. Certainly within our base case forecast, or even if it's not above 50%, at a very high probability, you have a slowdown that's likely to be a recession. Now, I would also caveat, only because the two most recent recessions that investors point to or remember most vividly are the recession that we all felt during COVID, and prior to that, the global financial crisis. Now, those were two large recessions, which that level of recession isn't what we're building into our base case. I mean, if you look at a standard, if there is such a thing, a standard recession kind of in the post-war era, you've had a 10 to 15% correction in earnings, and also a modest correction in valuations. So certainly from where markets are today, you would have a correction, but it doesn't necessarily mean you end up in a calamity, which is not our base case. Now, the second part of the question is about what would markets do? And I think you really have to answer this in a couple of ways. So if you look at US valuations in particular, they're very expensive, but if you take the top 10 companies out of the picture, valuations are much more reasonable. And I mean, as Ishrath mentioned, if you look at energy companies or materials companies, many of companies in those sectors are already priced as if a recession is coming. I mean, energy and materials have been sold off, while many other parts of the economy have not. And so, while you would likely see markets sell off, I mean, you really do need to look under the hood because some sectors would probably not sell off nearly as much. And then the last piece of it is obviously looking regionally. I mean, you do need to dissect global markets. So if we look at valuations in Asia, or in particular in China, as we've chatted previously, they're already 50% plus less expensive than what US valuations would be. You have economic stimulus taking place in countries like China and in Asia more broadly, while you still have tightening in the US. And so for that reason, you would really need to pick and choose. And I mean, we feel that we have a balanced approach where we are slightly overweight Asia, in particular in China, underweight more expensive US markets, but then also on a sector basis, as Ishrath mentioned, overweight sectors where a recession is more priced in than in others, perhaps not fully, but certainly more priced in than in others. Energy and materials as an example.
Yes, and I think that sort of you're raising the point that it's not about only about what is going to happen, but what is priced into markets, and then sort of deciding whether what is priced into markets is worse than or better than what you expect will happen going forward. So again, bringing it back to that valuation that is so important as an important part of the process, along with the top-down view. Sort of another thing that has been dominating a lot of headlines, I think with a lot of the geopolitical tension that has arisen, sort of seeing central banks increasing their gold reserves, is the question of whether the dollar is going to retain its global reserve status. What are our thoughts on that? And, sort of how do we protect in our portfolio against, obviously, that kind of geopolitical tension having an impact?
Sure. No, it's a great question. And I think that the time horizon over which one attempts to answer it is obviously very important. So if we look in the near term, or even in the medium term, we don't necessarily think that the dollar will lose its status as the largest global reserve currency. But we obviously see countries and central banks around the world doing a couple of things. I mean, we do see countries, in particular China, requiring trading partners to trade with them in RMB, for example. And there are other currency blocks slightly smaller that have arisen kind of globally as well. We also see countries wanting to hold assets or store value in something other than the USD. So on the margin, you've seen global central banks increasing their holdings of gold, which is also sensible. It's also what we own 5 to 10% of our multi-asset portfolio in gold. not as a hedge against inflation, but as a hedge against geopolitical risk and as a hedge against dollar devaluation kind of over time. What we do see, I mean, we always have to go back to the fact that, I mean, the US is still the world's largest economy. It's more than 24, 25% of global GDP, certainly far smaller than it used to be, but to be really unseated as one of the largest central bank reserve currency, there needs to be something else to own. And so if you look at kind of currencies that are easily transacted and tradable, a stable source of value, there are very few that would meet all of those criteria. I mean, even the RMB, for example, still has exchange controls. So to be used as a global reserve currency would be quite difficult. So it's a great question, one that we chat about quite often internally as well. It's one of the reasons, not exclusively, but one of the reasons that gold is a meaningful position in our multi-asset funds. But in the near term, we don't see the dollar being unseated for one reserve currency globally.
Yes, and I think one of the reasons that people do note, as you said, is percentage of global GDP. The US is still obviously the biggest contributor to world GDP, but hot on its heels is China. And the way that we actually obviously play that in our funds is to have exposure to great quality Chinese companies that are also taking advantage of spending shifts in that region as well. So I think that's probably how it features in our portfolio, some of the things that one kind of thinks about when you think about that topic. The last question, it's more of a recent issue, of course. Sort of the markets heaved a sigh of relief, I think, when the debt ceiling issue was resolved at the last minute in terms of the bipartisan agreement that was reached. But now, of course, we have potentially a wave of treasury issuance that may hit the market. What might be the effects of that? And that's from David.
Yeah, so it's also a great question. I mean, I think there's a very large portion of treasury issuance that needs to take place in the relative near term to keep the US kind of fully and firmly solvent. We are likely to see rates increase as a result of that, potentially at the short end, and potentially kind of somewhat acutely, though we do think the market will be able to digest the issuance completely, and that, I mean, Treasury and the Fed will be able to manage through that large issuance going forward. I mean, our view for interest rates, as I chatted during my portion of the presentation as well, sort of setting aside the large issuance that needs to take place soon to finance the debt, is for rates to continue to move higher from here, most likely, or at least to stay high for a longer period of time. So I think the most important piece, or the difference between our view and what the market's view may be, is looking forward over the next sort of 6 to 12 months. And our base case being, I mean, certainly we have probabilities that are outside of our base case that we look at as well, but our base case being that interest rates stay high. And I mean, we need to take into account the fact that they could move higher even from here before declining, which isn't what's currently priced into markets.
Okay, thank you very much, Brian. I'm going to do a quick summary before we close the session.
Thank you, Linda.
So Brian reiterated that our views on inflation remain largely unchanged, and that we still expect inflation to persist between the range of 3 to 5% for longer than what the market currently expects. And certainly that is reflected in terms of our difference in views with regards to the market's expectations of significant rate cuts this year and aggressively into the next year. However, he did acknowledge our concerns regarding the outlook for earnings. Having said that, earnings have fared a lot better than what we expected, and he discussed several factors that may have been supportive in that regard, notably that consumers have reduced their debt burden since the 2008-2009 financial crisis. They are a lot less sensitive to interest rates, and there is a very small percentage actually of mortgage holders who actually have adjustable rate mortgages. Many are fixed for quite long periods into the future. Additionally, he highlighted that there has been significant real wealth which was created as a result of the COVID stimulus checks, and that has provided more of a support to the economy than one might have expected otherwise over the past year. Nonetheless, there are still a number of risks which keep us awake at night and which we debate regularly every morning, which includes heightened geopolitical tension, both sovereign and corporate indebtedness, regulatory risks, and of course, the potential risks that Brian did highlight on the corporate earnings front. He did emphasize that we deliberately put together portfolios which are not reliant on one particular binary outcome. And our goal is for our portfolios to perform very well, if our views are correct, but to protect capital, even if our views turn out to be wrong. Brian then handed over to Ishrath, who gave you hopefully a sense of how investment ideas make their way into our portfolios and how that coming together of the top-down sort of thematic, macroeconomic driven views tie up with finding the best bottom-up valuation-driven opportunities that meet that particular theme. And he spoke about how there will be potential winners and losers in the energy transition and how as investors we can actually benefit from that. He looked at the direct correlation between global energy demand and prosperity and the fact that the demand for energy is not going anywhere, particularly coming out of emerging economies, which now are looking to industrialize at the same pace that developed economies did historically. And that while solar and wind energy have increased exponentially in terms of their growth, they still only account for a very small fraction of the overall growth in energy demand over the past decade, never mind sort of the total energy needs. Most of those needs do come from areas like Asia and China, and currently coal and oil and the more sort of hydrocarbon intensive fuels are still the predominant source of energy for the globe. Most economies, over 75% of the global population requires more energy than they produce. And despite the growth of electrification, there is still significant needs that need to be met by coal. However, gas is a very promising alternative. It is as dense, but it does have less damaging consequences for the environment. So we are starting to see increasing switch, obviously, out of coal and oil towards gas, which is a positive thing in terms of meeting needs as well as being less damaging to the environment. Unfortunately, there is no scenario in which oil and gas demand or supply can shrink significantly in the next decade, without creating significant problems for economies. And I think obviously here in South Africa, we see directly the impact of energy crises, particularly on emerging economies. And then he provided insights into how this all fits together with regards to our positioning in the space. We have significant investment in businesses that will benefit from the energy transition in some form, but also in the old energy sector, we have exposure to businesses with low production costs and with a tilt towards those that are providing gas in terms of meeting that less carbon intensive footprint. So unfortunately, it does seem that old energy and new energy will have to be part of the solution together. But overall, I hope that gave you a really good sense of how our process uses both that forward-looking element from a top-down macroeconomic side, as well as looking for the best opportunities from a bottom-up perspective to make their way in the portfolios. Again, I want to emphasize that we have no particular one binary view, that our portfolios are overly reliant with regards to us getting that right, but we actually try to put as many different investment ideas in our portfolios as possible with different drivers to actually create as stable a return profile over time, and importantly, to make sure that we always protect capital, something that's very important, particularly when there is a theme that gets sort of taken up by the market, which may create quite significant risks for capital losses at those levels. And ultimately, we spend every day putting together that top-down macro strategy. And then, of course, our investment professionals, both here in Cape Town and in Singapore, scour the globe daily for the best investment opportunities to invest your capital in. And we're confident that that will generate the right investment outcomes, as it has done for more than 4 decades for Foord investors over time. There is a survey that's going to pop up when this session ends, or when you end your session. Please do fill that in. We really would love your candid feedback. We want to make these sessions as productive as possible for you. And thank you so much for your time today. Have a lovely day.